All right, now we've got 8 minutes to go before the closing bell rings. Our countdown closers have a combined $6.8 trillion in assets under management. So I'm listening to them. I don't know about you guys, but joining me now, Empower Chief Investment Strategist Marta Norton and State Street Investment Management Chief Investment Strategist Michael Arone. Marta, right off the bat, give me your perspective on what's more important right now. A questionable move to cut rates in September, or valuations in this stock market, notwithstanding the drop today in the markets, but valuations that may be too rich?
Well, I think the valuations are pretty consequential. Now, I know that valuations themselves are not a market timing signal. Of course, valuations can be a touch high, and that doesn't necessarily spell doom for the markets. But when you start to get valuations that are at more extreme levels, and we measure that relative to an asset class's own history, looking at that decile breakdown, and when we start to see those valuations in those 9th and 10th deciles, I think those are fairly consequential. It doesn't necessarily mean immediate doom for the market. In fact, I'd argue there's a lot of reasons the market could grind higher, but it would suggest that the prospective 3-year returns are potentially a bit weaker. If you don't mind, just on that rate cut question, I think one consideration here is that even if we do get the September cut, the question is whether we're on an extended rate cutting campaign. And I think the commentary today and the general sense of the economy could suggest those rate cuts are a little bit more sporadic than the market might hope.
So 1 for the rest of the year, 2?
Well, I mean, I'll take a page from Powell's book and say it depends on the data. But I think you could argue that there will be kind of a extended cycle here, which could mean 1 to 2, but not necessarily 5, 6 over the course of the next several meetings.
Michael, what about you? I mean, what is the worst case scenario if the Fed holds rates paused once again in September, although Powell was very clear, no decision has been made on September, but you now have 2 dissenting voices. We've got Christopher Waller, one of the Fed governors, along with Michelle Bowman, both of them now saying, you know what, we need a quarter-point rate cut. If you give me a sense of what you feel might happen and how that affects the markets, would it be that bad?
Liz, just when you thought it was safe to go back in the water, the 2 things that could stop this rally breached it and took a big bite out of the rally. That's trade, tariffs, and the Federal Reserve. So in regards to the Federal Reserve, it's my opinion, I'm with Bowman and Waller on this one. I think that the Fed is miscalculating the impact on inflation that tariffs will in fact have. And in fact, when we look at today's GDP data, when we look at the PCE data, it slowed materially year over year, both the all items and excluding food and energy. So inflation was cooling in the first half. So I think the Fed has room to cut. They're already tight at 4.25, 4.5. They're way above the current inflation rate. They're just anxious. Powell told you in November he doesn't guess, he doesn't assume, and he doesn't speculate. But that's exactly what he's doing when it comes to tariffs. And I think the Fed's behind the curve, and they're missing an opportunity to cut rates. I think they'll cut rates 3 times in September, and then the final 2 meetings of this year.
Okay,
and I think it's a risk to the market if they don't.
I'm asking for permission here. And by the way, the Dow is coming well off its lows, still down 181 points. I'm asking permission if I can get really wonky here. The Taylor rule. So the Taylor rule is one of these rules that the Fed actually uses to decide where rates should be. It's a policy rule. It's a mathematical formula using GDP, consumer price index, and other data to calculate what the Fed funds rate should be. The Atlanta Fed has sort of a Taylor rule utility. It gives you options to calculate it, 3 different ones. Anyway, 2 of the options show that rates should be below where they are. They're at 4.25 to 4.5%. And this new, at least a couple of them say, we should be below 4.25%. So Marta, I mean, I'm just interested to know why the Fed isn't using its own rule to actually bring rates down.
Well, there's no question that there is. I like that idea of kind of speculating on the impact of inflation, or said maybe more gently, concerned about the tariff impact on inflation. Now, the market would agree with that assessment that you gave. If you're looking at what the 2-year is saying, it's suggesting that the Fed should be cutting. I think the question is, whether it cuts in September or not, how much can it actually cut? And one of the things Powell said, and I'm sure there's a range of opinions on the committee, but one of the things that he has described as kind of the posturing today is that the Fed is modestly restrictive. So that would suggest that that neutral rate is higher maybe than history would suggest. And so that would mean that even if the Fed is behind and it does begin cutting, it's not necessarily going to pull rates dramatically lower. And I think that's something that the market has to grapple with.
Yeah, I would think so. Michael, what do you like in this atmosphere? Because there are a few question marks, and I'm using the term few rather liberally here. There are quite a few question marks, and whether they come from some of these tariff deals that have not yet been solidified or what the Fed may or may not do.
So I think investors should stick with the trend and maybe barbell a little bit here. So I think we have 6 trade deals. I think we're likely to have more breakthroughs. That should help. We're going to have a free cash flow windfall from the One Big Beautiful Bill. That's going to help especially technology and communication services companies, for example. As I told you, I expect the Fed to cut rates beginning in September and for the remainder of this year. That should stimulate some growth. And Liz, we've never had a recession in the U.S. when earnings have been growing year over year, and that's likely to happen as well. So I think they should be invested cyclically, technology, communication services, where the earnings growth is. So we're going to get Microsoft, we're going to get Meta soon. I think those numbers are going to be great. It's going to be more important about what they have to say about the remainder of the year, and I think it's going to be positive. I like industrials, I like financials. I think all of those things are more cyclically oriented and should do well in this market.
Okay, less than 30 seconds before the closing bell rings. Michael, Marta, thank you very much.